Welcome back. Well, let's focus on the global markets because we have the European markets now trading at high point of the day. The Dow futures as well trading at high point of the day, and crude has also recovered. We have Jan Lambregts, global head of financial markets at Rabobank, now joining us. Jan, hi. Good to have you on the show. So, what do you make of today's stability in the financial markets after the kind of mayhem that we have seen?
Well, hope springs eternal, of course. We've had a really dreadful start to the year. At the center of that has been worries about the Chinese yuan, Chinese equity markets. We saw overnight that the Chinese equity markets were more or less stable. They ended up slightly higher. Japan was still a catch-up for yesterday, but all of this following a very late rally on Wall Street yesterday. So I think hopes there in the European markets that this is getting a little bit to calmer waters. We also saw the Chinese intervening heavily there in the offshore CNH market and closing the gap between the Chinese yuan and the CNH version of that in trade in Hong Kong at the expense of very high big spike in the HIBOR, the Hong Kong interbank offered rate. Whether it's really over, that remains to be seen. I think equity prices in China are still looking too rich there. If you look at it, if you look sort of at 2007, 2008, the correction we saw then, we haven't seen that type of correction yet. So there is still more to come if you just look at PE ratios in China. If the world's worried about that, and the world's worried because China's sort of the spender of last resort, that's still a theme that can come back later on in the year.
Okay. How do you expect risk assets to trend from here on, Jan? Say, at least for this quarter, we haven't got really fresh data of slowdown from China other than that PMI numbers, which are about 40 basis points lower. All of this is guessing that the fact that yuan was allowed to depreciate is an indication that the PBOC is feeling the heat of greater slowdown. It is still guess. We don't actually have data. So, therefore, you think the slowdown is factored in, or do you think risk assets should fall a little more this quarter?
Well, I think we still have a little bit of room to fall further, but you're making a good point, which is at which point do these risk assets turn around? There is precious little new news, to be honest. The market perhaps was a little bit too relaxed about the need for a further correction in China. Most people who know in the equity markets in China know that they're still looking too lofty and that correction was overdue. And to be fair, there only seems to be one way the yuan can go, and that is weaker as well, because the economy is just a lot weaker, and that warrants a weaker yuan. It's not that people really got more pessimistic on the Chinese economy. Chinese growth is a bit of a black box. Most people should realistically assume that growth has slowed significantly, but it has been a gradual slowdown so far, in line with what policymakers are saying. So it's more the equity markets, it's more the yuan at the moment, a lack of other drivers, and there, particularly today, they're also see still a little bit further downside, but some point these risk assets, at least globally, are going to recover a bit some, realizing that it's not all China driving everything.
Okay, so Jan, what's the slightly medium to long term prognosis? Do you think the developed markets will outperform the emerging markets, as has been the case for quite some time now?
I think in general they will, but the question is always with what's priced in there. I think a lot of people have turned pessimistic on emerging markets, have been moving some of their portfolio to the developed markets. I think correctly so. I think these developed markets will do reasonably well, but there's always the question of knock-on effect. In a way, the emphasis on China in sort of the start of this year is indicative of how slow growth is in the rest of the world. There is no clear growth locomotive, no clear growth engine. The US should probably be that, but it's so-so. Europe and Japan are still in a lot of trouble, and that is why China is getting such sort of outsized attention. So it's not all that clear cut. In general, I think the shift from emerging markets to benefit developed markets has been correct, but whether there's a further big push there remains to be seen.
Okay, I don't know whether India is a part of your area of research, but will you buy India now? I mean, we've fallen a good 15% from our one year ago highs.
There's pure contagion there. India sort of, in the good sort of global times, India didn't benefit as much because it is very much a domestic play. And that sort of makes me feel that in the bad times when the pressure is rising, India should relatively perform well amongst other emerging market peers because it hasn't had those same vulnerabilities. Now, that's all well and good, of course, but when you really have these big moves that we now have seen in the Chinese equity market since the middle of December, you do get sort kind of general contagion there. But I expect as we get a bit of calm coming through with India, we'll stand to benefit from that.
All right, we could do with that calm. Thank you very much, Jan Lambregts, for joining us with your take. So India, part of the EM contagion that started with China but could stand out. We are waiting for that day. Today we stood out as underperformers. Meanwhile, let's get you some more expert opinion on the global commodity markets. Morgan Stanley's Ruchir Sharma is of the view that crude prices have probably reached a bottom. Below current levels, it will be hard for prices to sustain. On China, he shares his view with other experts who believe that the slowdown has been a long time coming.
Commodity prices from here may not fall much further, but what you can expect is an extended trading range. And for the price of oil, I think that about 5 years ago, we all thought that $70 to $80 was a floor for the price of oil. That's likely to be the cap for the price of oil in the next 5 to 10 years. I doubt that we're going to get much below another 10-15% on the downside for oil. But there's always a possibility for an overshoot. But it's very hard to see as to how the price of oil can sustain much below $30 a barrel. So I think that from 30, we could possibly bounce back up to 40, 50, and then languish there for a long time to come. What's been happening in China has really been taking place over the last few years, which is that there's been a massive buildup in debt. In fact, there's no other developing country in history that has taken on debt as rapidly as China has done since the 2008 global financial crisis. And I think that's really what's happening now, that it's paying a price for this massive accumulation in debt. Now, when exactly this will lead to a meltdown is very hard to call, but this is the big risk that the global economy faces currently.
Right, well, that's the word, big crisis still on from China and a mild global recession on the cards. We wrap up this edition of Markets Today on that note.